Okay. Now let's straight away go into option valuation, basically option models, and what are the factors affecting option valuation. Okay. First of all, option valuation means what is supposed to be the premium. Okay. That's what we're trying to understand. Option premium, that's what we say, option price and option value. Okay. Let's think from holder point of view. Let's think from holder point of view. And to be specific, let's say think from call option holder point of view. Now tell me, what is his outflow and what is his inflow? And when does he get it? Can you tell me, for a call option holder, when does he pay? He pay today or he pay on expiry? Outflow will happen today, right? At point 0, outflow will happen today. And what do you pay exactly? What you pay is option premium, correct? What you pay is option premium. And what inflow you get, or when will you get the inflow? When you will get the benefit? Of course, assuming no square off before that. When will you get the inflow? Not today. On expiry, you get the money back. On expiry. Okay. Now, what is the benefit is called as? Can you tell me for the holder? Be a polar put or call. What is that inflow that a holder gets if the option is exercised? And that is called as intrinsic value, right? Intrinsic value. Intrinsic value. Now, what does intrinsic value comprise of? Intrinsic value comprise of two factors. One is market price, the other is strike price. Market price, strike price. Now, a strike price does not change because we always calculate premium for a strike price. We know that strike price, that is always same. For different strike price, we get different premium. We are not talking about that. So, market price, strike price. Okay, so what are the factors that is going to influence option premium? Market price will influence, strike price will influence. So you understand, right? This option premium is like an investment today, and intrinsic value is the benefit you are getting. See, if you remember, like a project, capital budgeting, machinery, you purchase the machinery and you get the benefits over a period of time. That's how we calculate NPV. How we calculate NPV? Initial outflow, purchase price of the asset, then present value of inflows. Any decision, you will have an outflow, you will have an inflow. So option premium is paid because you are going to get the intrinsic value after expiry. Now, if suppose intrinsic value is 30 rupees after 6 months, now you please tell me, today will you pay 30 rupees? What do you think? If the intrinsic value, the benefit you are going to get 30 rupees after 6 months, today are you ready to pay 30 rupees for it? Obviously no. Why? Because time value of money. So intrinsic value has to be brought into time value of money. What is the time value of money? It comprises of two factors. One, rate of interest, and the other, time period, time to expiry. Time to expire. Time to expire. Okay, now market price. Now market price, do we know in future what would happen in advance? Obviously, we don't know in advance. It's always uncertain. Okay. When something is uncertain, but we have to estimate something. In statistics, how do we calculate the estimated value, expected value? What is it being used? We can use probability, right? We can use standard deviation, because we tell, oh, in the history, what happened to this stock? Average price around 60 rupees plus or minus 5 rupees. Another stock is also 60 rupees but plus or minus 70 rupees. You understand? That is called as probability or standard deviation. Together, actually, the movement of market price, it's called as volatility. Okay. So I can say market price, uh, then I'll say two things. One is probability, market price, probability. Okay, fine. So basically, what are the factors affecting option valuation? Means you can mention these things. You can say probability. It's also called as volatility, or that is standard deviation. The chances of movements, that is probability, volatility. So if they ask you what are the factors affecting option valuation, let's list it out one by one. Theory question can be asked. A logical also can be asked. Okay. So factors affecting option premium, option valuation. What are the factors? We have market price, we have strike price, then rate of interest, time to expiry, volatility or probability. Okay. So when the market price change, option value change. Actually, there is an option Greek for that. The rate of change. We are going to discuss later, but I'll give an idea now itself. Rate of change is measured something called as market price change is called as delta. What is delta? If 1 rupee market price changes, how option premium will change? How do you calculate that? We should know option valuation, but you understood, right? There are various factors changes. If the factors changes by 1 unit, how much option premium will change? That's called as option Greeks. Understand option Greek meaning? Option Greeks. There are various factors influencing option. We will discuss in option valuation. If one of the units changes, if one of the factors changes, option value will change. By how much change? Rate of change in price for every change in rate of variable. If remember, we had in bond, there was only one factor which is changing because the coupon was fixed, redemption price was fixed. The only reason for the price to change was only one thing. Remember why the bond price used to change? Only one reason. Coupon is there but fixed. Redemption price is there but fixed. But because of one thing which fluctuate, market price also fluctuates in bond valuation, and that is YTM. Right? When the yield changes, present value reduce, and we call that as volatility. We call that as Macaulay's duration or convexity. we have given different names. But there was only one factor. But here we have multiple factors. So for different factors, we have different measures. So changes in market price is called as delta. Strike price, it will not change, it is fixed. For a strike price only, we are computing premium. So strike price, we don't change it. Rate of interest. If rate of interest change, how the option will change, that's called as rho. Time to expiry, that's called as theta. If one day changes, how the option value will change. Volatility changes, that's called as vega. If delta only changes, if delta changes, that's also there, we call that as gamma. So basically we have this, you anyway fix it, don't worry. Delta, gamma, rho, theta, vega. 5 Greeks are there. I'll discuss again towards the end of this chapter. Just keep it in mind. These two are connected, so I'm telling you in advance. So we have certain factors affecting option valuation, and we have the measurement of those impact. These factors will change. How much? We have these option Greeks. How much market price will impact? How much rate of interest will impact? How much time decay will impact? How much volatility will impact? So all these called as option Greeks. I'll discuss again towards the end of the chapter. Hope you have taken down this. Done? Okay. Let me give you some basic factors, basic concepts to be kept in mind for valuation. Then I'll go to the binomial model, I'll go to risk neutrality model, I'll go to Black-Scholes model and all. But first understand the basic structure of valuation. So option valuation structure. Okay, option valuation structure. Okay, let's write today. An expiry. Okay, let's say strike price on expiry. Strike price is let's say 100 rupees. This is known in advance, fixed, you know it. And let's talk about call option. Okay, let's talk about call option holder position. Now tell me, call option holder position, strike price is a buy price or sell price? It is buy price, right? It is buy price. And at what price you are going to sell? At market price you are going to sell. So market price is unknown, uncertain. Let's assume I know. In my dream it has come. My God has told me it is going to be 120 rupees. It is going to be 120 rupees. So what is the intrinsic value? I would say intrinsic value would be 20 rupees, correct? 20 rupees. Now, will I pay 20 rupees for my premium? If I say option premium, if I pay 20 rupees, will I be at advantage? No, because 20 rupees I get after some few months. Let's say this is 1 year time period. And for simplicity's sake, let's say interest is 10%. So how much I will be ready to pay today? Not 20 rupees. And this interest is risk-free. Let's say risk-free interest. Risk-free interest, 10%. So what is the value today? Why 10% risk-free I'm taking? Because for different people, different value can come. We don't want that. You want a common number without risk. What is the value? If nothing else happens without risk, 20 divided by 1.1 I can do. 20 divided by 1 plus 0.1. 18.18. Which means if I pay 18.18 and I know market price is 120, What do I get then? Can I tell I'll get risk-free return of, if there is no uncertainty in market price. First, we are assuming everything is same. Everything we know. If there is no uncertainty, like a bond, we have redemption price, right? For a bond, the redemption price, like that, I know. If there is no uncertainty in market price, then this call option is worth 18.18. This call option is worth 18.18, giving risk-free return of 10%. Giving risk-free return of 10%. Now, after 6 months, this value will change because of time value. If rate of interest changes, that also will change. That is a different issue. But we are assuming everything we know in advance. Basic structure, are you clear? I know the market price, assuming to be certain. Strike price, that is anyway fixed. Time period, I know. Rate of interest, I know. Everything is fixed. That means this option gives me risk-free interest. Don't ask me a question, sir, if the option is risk-free, why I will go to FD only? No. First, I'm starting with risk-free. Then I'll change one by one element. When the risk element is involved, how these things will change. So we'll take one point at a time. So what is my base situation? Base situation is risk-free. I know market price. I know risk-free rate. There is no volatility. Strike price anyway fixed. 20 rupees I'm going to get the profit. That means this is worth 18.18. Hope basic structure is clear. Now, one situation I will give you. Now, instead of one market price, let's try to change the complexity little bit. Instead of having just one market price, I will give you two market price. That is, either it can go up to 140 or it can come down to, let's say, 80 rupees. So from one market price, from the base situation I've started, I'm slightly complicating. I'm making it as two price. Any idea what is it called as? When you have anything two, what do you think would be the technical word? That is what is binomial. I mean, technical in mathematics. Binomial, by something means two, two possibilities. And I'm not, I mean, it can be 4, 8. The Black-Scholes model will consider all possibilities, but we'll think one thing at a time. Hope the structure is clear. We started with the basic one price. Be easy to calculate. If there are two price, and I'll give you equal chance. That is, there are equal chance. Now, market price can be either 140 or 80. Equal chance for simplicity's sake. Okay. Now, how I'm going to calculate? Please observe. Uh, this is today. Same example on expiry. Again, I'm doing for call only. Strike price anyway fixed at hundreds. Now, market price, which number will you take? Can you please tell me? Which number will you take? Will you take 140 or 80? But we need one number. How do we convert the two numbers into one number? How do we convert the two numbers into one number? We'll take an average. But we have probability there. So can I do expected value or average based on probability as the weight? You understand, right? Expected value. Value that is 140. What is its probability? 0.5. Correct? 140 into 0.5 plus 80 into 0.5. Are you understanding? Is that right, my dear friends? Are you able to get it? Weighted average I'm doing, equal chance or simple average you can do, because equal chance means simple average is also fine. So 140 into 0.5, that is x into p. You remember x column, p column, x into p product column. I'm doing horizontally. So what is that answer going to be? 110. Okay, 110. Strike price 100. So what is my intrinsic value? Intrinsic value going to be intrinsic value 10 rupees. And if I do present value of that, what is present value of 10 rupees? 10 rupees divided by 1 plus 0.1, rate of interest, time period is 1 year, 9.09. This is what should be the option premium, like the previous 18.18, now 9.09. Okay, this is wrong calculation. Overall, your concept is right, but your calculation is not right. I'll tell you why. Your calculation is not right. I'll tell you why. Okay, if you remember the basics, my dear friend, when I say expected value, two column will be there. One column is x, one column is p. X into p, I get the expected value, right? I repeat this. When you want to calculate average marks, what should be the column x represents? Please tell me. If I want to calculate average marks, the x column should represent what? Marks. If I want to calculate speed, then my x column represents speed. If I want to calculate return, my x column should contain what? Returns. Here what I am calculating? Expected intrinsic value I have to calculate, then present value. So expected intrinsic value is not expected market price minus strike price. Expected value, how do you calculate? I have to calculate various intrinsic value, then their probabilities. Are you understanding? Which means if market price is 140, can you tell me the intrinsic value? If market price is 140, what will be intrinsic value of call option? Market price minus strike price, 140 minus 100, 40. If market price is 80, can you tell me intrinsic value of call option? What will be that number? Lapse, correct, will become 0, not negative, right? Call option always gives a choice. It becomes 0. And the probability of 40 is 0.5. Probability of intrinsic value is also 0, is also 0.5. Now you tell me 40 into 0.5 plus 0 into 0.5. This is expected intrinsic value. That is going to be 20. That you do present value. 20 divided by 1 plus 0.10. You get 18.18, right? 18.18. Are you understanding what mistake you would have done? When they ask you to calculate expected intrinsic value or present value, if you calculate, don't compute expected market price. Don't use shortcut. If you use shortcut, you know what means? This you're writing minus. If I do 80 minus market price 80 minus 100, this is minus 20. If I do minus 20 into 0.5, that if I subtract, then I get the numbers. The calculation correct? 140 minus 100 is 40. 40 into 0.5, 20. 20 divided by 1.1, 18.18. Okay. 10 by 1.1. Okay, that would have been the number. Okay, if I have to give you the a quick verification, what it would mean. Just do one thing. Suppose if you take this as minus 20, 80 minus 100, minus 20 into 0.5. What would have happened then? What would be your value then? Uh, Here you get 40 into 0.5, 20, and minus 20 into 0.5, 10. You would have got it as 10, right? That is what this number would mean. Are you getting that point? If you directly take expected market price, it means negative number you are taking intrinsic value, which is not right. Therefore, what you have to do when you calculate intrinsic value, you should take individual values. I'll give a simple summary now. So when you have to calculate expected intrinsic value, okay, if you want to calculate expected intrinsic value, what you should not do, what is the wrong method? X, you take it as market price, then they'll give you probability, then you do the products, you get expected market price, then minus strike price is intrinsic value, is wrong methods. What is the right method? You have to calculate at each price what is the intrinsic value. What is that each price intrinsic value? Market price minus strike price, one number. Market price minus strike price, second number. And something may be zero. Option lapse. That you multiplied by probability. Then you do the product. That product total column is expected intrinsic value. Okay, so show the last side once. This was the last side. That is option valuation structure. Okay, write down this table and keep the concept in mind. When you calculate, don't use expected market price as a shortcut. That will be wrong because that assumes you're exercising the option even when you have negative intrinsic value, which is not right. But many people will fall for it. So don't follow this method. The right method is you compute intrinsic value at each stage for each market price, multiply by the probability. That column total is expected intrinsic value. Write down this format. If you have any doubt, you can ask me. This is the basic structure. Okay, fine. So this is the basic structure of option valuation. Then we have binomial model. Then we have risk neutrality model. Binomial only risk neutrality. Then we have Black-Scholes. All those things we'll take it up in the subsequent sessions. Hope you got the basic structure. We'll apply it later. Okay. Come to this problem. Come to this problem. Along with this problem, we'll also understand the basics of option valuations now. Option valuations methods are there. Binomial model, risk neutrality model. We'll learn it later. But as of now, with this problem, we'll understand the basics of valuation. Valuation means what is supposed to be the option premium. What are the factors that will influence option premium? That concept we'll understand with this problem. One of the popular questions asked in examination repeatedly. Come to this problem. You as an investor had purchased 4-month call option on equity shares of X Limited of rupees 10, which current market price 132, excise price 150. You expect the price to range between 120 to 190. The expected share price of X Limited and the related probability is given below. Expected price, probability. Compute the following. Expected share price at the end of 4 months. Value of call option at the end of 4 months if excise price prevails. In case the option is held to maturity, what will be the expected value of call option? Okay, First, on the expiry, expected share price along with probability they have given, and they're asking expected share price. So how do we calculate the expected share price? Basic concept, share price multiplied by respective probabilities. So let's write X as share price, then probability, then X into probability, the product, X into the probability. The product will give you the expected market price, expected value, mathematical value of expectation. So 120, 140, 160, 190, 120, 140, 160, 180, 190. Probability 0.05, 0.2, 0.5. 0.1, 0.15. Multiply 115 into 0.05, I think 6. 114 to 0.2, I think 28. 116 to 0.5, 80. 118 to 0.1, 18. And 119 to 0.15. 28.5. Please do the total and tell me what is the amount you get. 160.5, right? So expected market price on expiry is 160.5. 160.5. First part of the question. Second, value of call option. When they say value of call option, at the end of 4 months, nothing but intrinsic value. Value of call option on expiry. Value of call option on expiry at the end of 6 months. Nothing but intrinsic value. Intrinsic value. If excise price prevails, what do you mean by if excise price prevails? If excise price prevails, if excise price means strike price prevails, can you tell me what you mean by this? Excise prevailing where? Excise price prevails means excise price is prevailing, present in the market. In other words, if excise price is same as market price, if excise price prevails, implies market price is also equal to the excise price, which is equal to excise price of 150. Excise price of 150. Excise price of 150. So what is intrinsic value of call option? Market price minus strike price, both are equal. So 150 minus 150, 0. Basically at the money situation. Market price equal to excise price. Market price equal to strike price. Excise price prevailing means that is equal to market price. If market price, excise price both are equal, intrinsic value is 0. Next, in case the option is held to maturity, what will be the expected value of call option? Expected value of call option. on expiry. On expiry means again intrinsic value, but not the actual market price, expected value. Now, please tell me this. What is the value formula of intrinsic value? Market price minus strike price. Since strike price is not available, strike price given, which market price to take? Don't tell market price equal to strike price, sir. That is second part of the question. We are in third part of the question now. Intrinsic value formula is market price minus strike price. Strike price, we know it is 150. What is market price? So many market prices are given. But no problem, sir. All these different market price, we converted into expected market price. So expected value of call option is expected market price. Expected value of call option is expected market price minus the strike price. Expected value, expected market price is equal to 160.5 minus 150. That is equal to 10.5. 10.5. Simple, very reasonable. Expected value of call option. Expected market price minus strike price. 160.5 minus 150. 10.5. That's all. Very clear? Okay, I hope no doubts. Okay, once you are done, use this beautiful drawing. Please cancel this. This is a wrong, this is a mistake, and this is the commonly done mistake in exam because you don't even realize this is a mistake. It seems very, very correct. I'll tell you why it's wrong. Back to basics. How do you compute expected value? Expected value under statistics. You want expected marks into probability. You want expected price into probability. You want expected speed, the speed into probability. So if you want expected value of call option multiplied by probability. Are you getting it? Whenever we calculate any expected value, those values should be our x values, then multiplied by respective probabilities. So expected value of call option means first one column, you list out the value of call option, then you multiply it by probability, then the products will give you the answer. Don't use shortcut. Sir, don't you think answer should be same? No, I'll prove how. Come to this. Now, first situation, market price is 120. Excise price, strike price is 150. Now, please tell me, will the option be exercised? What is the value of call option? Market price is less. Strike price is 150. Market price is less. What is the intrinsic value of call option? Call option will lapse. Yes, though it is market price minus strike price. 120 minus 150. We don't write minus 30. We will write 0. This is the culprit. The number will not match. I'll show you how later once more. Okay. Now if it is 140, 140 minus 150. Again the option will lapse. You will not exercise. Negative intrinsic value will not come for a holder. Then next 160 market price. 160 minus 150, that is equal to 10. Then 180 minus 150, that is equal to 30. 190 minus 150, that is equal to 40. All these things are fine. Multiply by probabilities. 0.05, 0.20, zero point 0.5, 0.10, 0.15. See, I made you to write and then I made you to cancel it. So you should remember, we have done and we have done the cancellation. So when you do a mistake, always learn from it. Don't do same mistake once more. So if you have done something wrong in your material also, if you scratch it, it's good. Don't do whitener just because it's available free in the office. Let me use something and use whitener, make it clean, look like clean. Not necessary. There has to be a trail of a mistake. Audit point. There has to be a trail of a mistake. Then only you learn where I've done mistake in the past when you revise. So when you cancel it, let the proof be there. When you revise it, you look at that once more. You understand that mistake will not be repeated. Okay. So let's multiply. So 0 into 0.05 is 0. 0 into 0 point is also 0. 10 into 0.5 is 5. 13 to 0.1 is 3. 40 into 0.5 is 6. So you get total 6, 3, 9, 9 plus 5, 14. So expected value of call option on expiry, on maturity is 14. Is 14. Now I'll tell you why the 10.5 was not correct. I'll tell you how that number will add up beautifully. I'll tell you. Please observe. Here we wrote 0, 0 because market price was less and the option was not exercised. But please tell me, you forcefully assume it. It is exercised, let's say. Forcefully you do it only for calculation purposes. What will happen? This will be minus 30. Minus 30 into 0.05 means how much? Minus 1.5. And this is 140 minus 150 means minus 10. And minus 10 into 0.2 means it becomes minus 2. So this is 5, 3, 6. Now please tell me how much total comes to? Had you forcefully exercised, what would be the value under this approach? Minus 1.5, minus 2, plus 5, plus 3, plus 6. How much it will become? It will become 10.5, which is what we had got here, which we cancelled, which was a mistake. Are you getting the point? If you write 10.5 directly using the expected price, it assumes option is exercised under all situations. That is the interpretation if you do market price directly. But we know it is not exercised in all the options, all the cases. Therefore, direct calculation is not right. We should calculate individually. This is the problem. It's repeatedly asked. First part, second part of the question is not okay. 1 mark will be there. This only will be there for like 4 marks, 3 marks, like that, for a higher weightage. So this is only important one. So we are paying focus on this. Hope you got the point. What mistake you do and what is the interpretation of that mistake and what is the right answer. But with this problem, do you understand how and all value of the option will be determined? Probability will play a role. Market price range, standard deviation will play a role. Strike price will play a role. And all these things are on expiry date, intrinsic value. But premium paid today itself. So premium should be paid today towards the intrinsic value. Premium is like investment. Intrinsic value is the recovery, inflow. So there will always be time value of money also, meaning rate of interest and time period. So all these factors will influence option premium, meaning option valuation. That's what we are going to discuss in binomial model and risk neutrality model. We have it later. We will discuss it later, but this is just a lead up where what are the factors which will influence the value of call option or call option premium. These are the value of options on expiry date, factors influencing it. Okay. Shall we go further? Any doubts? Is it done? Shall we go further? Is it done? Please confirm. Okay, yes, let's go further then. Okay, so let's do next problem. Let's do next problem. A call option has been determined, has been entered into by R now for delivery for share of X Limited at 460, strike price 460. The expected future price, meaning price on expiry date, expected future price of at the time of expiry of contract are as follows: a price probability. Determine the premium at which Arnav will break even. Now, here don't do the shortcut. So, what is the break even point? Remember, it is the strike price plus premium. So, 460 plus the premium amount is how much, so that it is equal to the no profit no loss. We can't say this is equal to market price, and market price calculate by probability into this price, expected price. Don't do that method. We have learned we should not do market price as expected market price. We should calculate individually. In the sense, we will calculate one column for premium will break even means payoff. Break even point means payoff should be 0. Hope you remember payoff. And how do you calculate payoff? Let's have one column market price on expiry. Hope you remember the format. Then we'll write intrinsic value. Then we write premium. We don't know how much is premium. Then we write payoff. Then here we also have probability. Then we get the product. We get the expected payoff. Let's write down. The market price on expiries are 470, 450, 480, 490, 500. Intrinsic values, strike price 460. In first case, how much is intrinsic value? 470 minus 460, 10. Sorry, market price 470 minus 460. 450 minus 460. How much? Plus 10 or minus 10? How much you get intrinsic value? 450 minus 460 plus 10 or minus 10? 0. Correct. Neither plus 10 nor minus 10. 0. Correct. 480 minus 460 is 20. 490 minus 460 is 30. 500 minus 460 is 40. Premium we don't know. Let's say X. Payoff will be 10 minus X, 0 minus X, 20 minus X, 30 minus X, 40 minus X. Probability multiply 0.2, 0.25, 0.35, 0.05, 0.15. So 10 into 0.2 means 2 and X into 0.2 means minus 0.2X. X into 0.25, 0.25X. 0.35 into 20 means I think 7 minus 0.35X. 0.30 into 0.05 means 1.5 minus 0.05X. 40 into 0.5 means I think 6 minus 0.15x. And this is what our expected value. And this should be how much? Break even. Means this expected payoff should be 0. Please add all. How much you get? 2 plus 7 plus 1.5 plus 6. Hope numbers are fine. Please validate. 2 plus 7 plus 1.5 plus 6. That is 16.5. Then minus all these x's. 0.2 minus. Then this is minus, sorry. This is minus x, no? So this is minus 0.25. Minus 0.25. This is minus x. Remember, minus 0.25. So 0.2, 0.25, 0.35, 0.05 plus 0.15. 0.2 plus 0.25 plus 0.35 plus 0.05 plus 0.15. You get 1x. That is 1 only. X equal to 0. So you get x equal to 16.5. So premium, break-even point, premium for break-even should be 16.5. There is a better method. I'll explain it to you. I'll do it for this problem. But first you take down. This is what Institute suggested. I'm showing you this. Okay, hope it is done. Okay, now one more method what we can do. We will compute the expected intrinsic value like the previous problem. Then we'll say that it's equal to premium amount. We can do it. I'll show it to you. Please observe. We did so much, but I'll tell you how it is much easier. Okay, now if you have to calculate expected intrinsic value, then what it would be? We multiply this by probability and then we get the product. Let's see what do we get. Probability is 0.2, 0.25, 0.35, 0.05, 0.15. Please multiply this. See what you get. 10 into 0.2 is 2. 0 into 0.25 is 0. 10 into 0.35 is 7. 30 into 0.05 is 1.5. And 40 into 0.15 is 6. How much you get? 13, 15, 16.5, right? 16.5, which is same number. They could have asked this directly. Same like had they asked expected value on expiry, that itself is break-even premium. Just to confuse, they asked this question. We also did like the institute solved it. This is the answer. Why? I'll tell you. What is the payoff formula? Payoff formula is intrinsic value minus premium. Correct? Now here, payoff is 0. So what is the interpretation? Payoff is 0. Intrinsic value minus premium, which means your intrinsic value expected intrinsic value is equal to premium, then you will get break-even points. So instead of asking same thing, they asked the answer like this. Some wrong way they told, we also followed the method, but answer would have been straightforward. Expected intrinsic value is equal to premium for break-even point. If you pay premium less, profit. If you pay premium more, it is going to be loss. Okay, so answer is such a simple thing, but we did so much long method. But if you remember, we added that x total. That gave 1x only. Why? Because every column had x multiplied by probability. Everywhere x multiplied by probability. Total will be 1 only, no? X only. Anyway, you leave at that point. Concept to remember, expected intrinsic value is calculated by intrinsic value multiplied by the probabilities. Total product will give you the expected value. And that expected value is nothing but the premium. If you pay, you are break even, because intrinsic value is inflow, premium is outflow, and opposite for writer anyways. So difference will be 0. Anyway, so that is the concept on this problem. I hope you have taken it down. Okay, so now let us go into the world of option valuation, which is more relevant, definitely more relevant from the exam point of view, from the past topics what you have discussed so far. Now, what do you mean by option valuation? Option valuation means finding out theoretical value of option premium. Okay, so let's just write down sentence. Option valuation means finding out theoretical value of option premium. Finding out theoretical value of option premium. Finding theoretical value of option premium. What do you mean by that? What is supposed to be the option premium? Option premium means option price that will be available in the market. But what if it is option value? What is supposed to be the value? And that's what we want to calculate. Let me just illustrate once more. So option premium means option price. And this is available in the markets. Available in stock exchange, available in market websites. But option value, that is what we are going to learn. That is theoretical value. Theoretical value that is available in option valuation methods. We have broadly two methods: binomial method, and then we have Black-Scholes methods. Broadly, we have two methods. That's what we're going to learn now. Okay, so in general, you please understand, in general, what is the process of option valuation? Today, what cash flow takes place today with respect to options is option premium. And on expiry, what cash flows takes place today, and that is intrinsic value. You know, right? Difference between market price and strike price, not going for a below zero value, either on call option or on put option. Now, if I do a present value of this intrinsic value takes place on expiry. Option premium takes place today. Option premium is like investment, right? This is investment outflow, and this is recovery of investment inflow. So intrinsic value which takes place on market on expiry, option premium takes place today. Now, what is supposed to be the amount? Theoretical value. This theoretical value. What is supposed to be the amount, and that's what called as option valuation. Hope you got the basic idea. Okay, now we have binomial method, which has two methods further. Both will give same answer. Under risk neutral model, we have two things: one period model, two period binomial. We'll discuss that. And we have Black-Scholes model. First, we'll come to binomial model. In binomial model, we have portfolio replication approach, and another one we have risk neutrality approach, and then we have multi-period binomial problems. First one among them, portfolio replication approach. Okay, what do you mean by portfolio replication approach? So here we use the concept of little bit of hedging also into consideration. Do you remember in fair value future how we calculated? We had considered risk-free interest. For spot price, we have added risk-free interest. Means what? That stock should give you risk-free return. That stock should give you return like a risk-free asset. That should be the future value. That should be the minimum future value because that represents time value of money. A similar approach here we follow it. How do we follow? Slightly differently we do it. We have a portfolio shares and we bring in this option. Together we make our portfolio. That's why it is called as portfolio replication approach. Let me write in sentences, you'll get an idea. So under this approach, I'll also write down along with you, give the heading portfolio replication approach, then you write below that under this approach, a portfolio of shares, that is within bracket markets, combined with portfolio of shares combined with a position on option, combined with position of options makes portfolio risk-free. Makes portfolio risk-free. A portfolio of shares combined with position of options, position on option together makes portfolio risk-free, like perfect hedging. Like perfect hedging. Okay. Now, normally what position we take on portfolio? Normally on portfolio, what position we take? On portfolio of shares. Normally on portfolio of shares, we take long position. That means you're expecting the price to increase. Now, if you want to take a position in options, what position should you take? If you want to do a risk-free portfolio, you know the basic concept of hedging, you need to take an opposite position, you need to take a short position. Perfect. So on options, you need to take a short positions. But you know, short position can be taken in two places. Short position can be taken in call option writing or let's say put option holder. Both are short position only because call option writer also expects the price to come down. Put option holder also expects price to come down. Both are possible. Similarly, normally it is long position, but some extreme cases you can also theoretically you can have, not an exam problem, but theoretically you can have portfolio of shares, short position, and on options you take long position. Earlier it was short on options, now long on options, basically opposite. Means what do you mean by long on option? You can buy call option holder, you can become call option holder, or you can become put option writer. Both are long only, put option writer. if you go short on portfolio. So basically, how many possibilities are there? You can understand this portfolio replication approach through 4 combinations: on shares long, on call option writing, combination 1; portfolio on shares long, put option holder, second combination, second method; portfolio on shares short and call option holder position, third combination; portfolio on shares short and on long on put option writing, fourth option. So you can understand this portfolio replication approach under these 4 categories. Under these 4 categories. But we will not go through all the 4 categories. We'll go through popular one, which is definitely sufficient for exams. You can replicate for others and you find out the ultimate answer will be same. So let's understand one combination to get the formula for option premium calculation. You can try other combinations also. Ultimately, same answer will come. Okay, so let's try with the first combination. Hope you've done till here. Four combinations are possible. We'll take only one combinations. Okay, so portfolio application approach. Let's say portfolio on shares. We take long position and let's say call option. You become a writer. Together, your portfolio becomes risk-free portfolio. Okay, just write down this and write one sentence. I'm trying to give you derivation of formula. Not required, but if you are having derivation of formula, you can make a little bit more interpretations. Okay, now just write down. Write down. Option premium is calculated. Option premium is calculated in such a way that option premium is calculated such a way that portfolio and shares together with the premium on options together with premium on options becomes risk-free asset becomes risk-free asset becomes risk-free asset becomes risk-free asset. Okay, now let's understand how it becomes risk-free assets. uh, Now, one more point, binomial model. In English, when we use the word binomial we use the word binomial, biometric, binomial, by two. So whenever we want to express two possibilities, we use the word binomial, biometric, bio. The term usually used for two possibilities. So here we are only looking at two possibilities. Either market price goes up or market price comes down. Okay. Now, so today portfolio. How do we write? Okay, I'll just write the formula. We'll come to it later. So today portfolio will be, you will have one share, let's say. So one share I'm taking an example, into current market price. This is value of portfolio minus option premium on call. So I will say value of call into delta. This is the portfolio position on shares and this is the portfolio position on options. Now, one share into current market price. This is today's investments minus. Sir, why are you subtracting? Because in call option writer position, you receive premium. When you receive premium, your cost of investments comes down. Are you understanding? Or other way around, portfolio and share asset side of balance sheet. Writing short liability side of balance sheet. Writing means obligation. So on the asset side you have portfolio, liability side you have options, net amount I'm calculating. So I'm subtracting. Why delta, sir? Because the risk of one share is not equal to risk of one the movement of one share is not equal to the movement of one option. Like if the share is loses by 10 rupee, on the option exactly you don't lose by 10 rupee. It's not the case. That's why we have computed delta. Delta means basically fractional number of shares for a theoretical purpose, for calculating formula purpose. Fractional number of shares. As of now, assume fractional number of share exists. Then how do we convert this into practical aspect? I'll come to it later. I'll discuss what is the interpretation of delta, how delta can be made use of, then how delta can be used in practical life. I mean, how this fractional thing can be converted into full thing. I will explain you later. As of now, theoretically, try to remember fractional number of shares. It's mostly ratio basis. Ratio basis. Hope you got the point. Now, two things can happen. Price goes up, market price goes up. That is, let's say high price for H. Or what else can happen? Price can come down. Price comes down. Price comes down. That is, it will go for low price. Now, if price goes up or price comes down, what is the value of portfolio? Let's say in future, value of portfolio. What's going to happen? If price goes up, one share what you have becomes high price. One share what you have becomes high price. Portfolio of shares goes up. And in call option, you have written the call option. So in call option, you have written the call option. So can you please tell me now? Sorry. There's one small change. We don't want to compute for one share. We want to compute one delta for how many number of shares. One second. One small change I'll do with the calculation. This I'll just interchange. You can do like this, but I'll just be more clear. So I'll take on one call option, fractional number of shares, delta. For one call option, corresponding number of shares I take a position. The reason is same. The risk of one option is not equal to risk of one share. So one call option if I take, number of shares I need to do fractional number of shares. And how do we convert this fraction into full? I'll tell you later. As of now, we'll understand theoretically. Now, what is the value of portfolio? You have fractional number of shares, delta, multiplied by current market price is high price. So I'll say H. Now, can you please tell me from the fractional number of shares on the call option position, writing price goes up. Do you make profit or do you make loss, or intrinsic value becomes zero? What is the intrinsic value in this situation? If the price goes up, what do you think? What is the intrinsic value formula for call option instruments? What is the intrinsic value formula for call option instrument? For intrinsic value formula, intrinsic value minus premium. I'm asking you intrinsic value. Market price minus premium. Okay. Intrinsic value formula is market price minus strike price. That is the intrinsic value, correct? For a call option, that's a fundamental thing. And that is going to be minus market price minus strike price. That is intrinsic value for call option, and it's going to be minus because it is for a writer. It is for a writer. So market price, in this case high price, strike price, I'll write it as SP. So in the call option, you lose intrinsic value, high price minus strike price. Sir, premium already considered. No, this is the cash flow at the end of the period. On expiry, I'm calculating value of portfolio on expiry. On expiry. So don't consider premium. This is the intrinsic value. Okay, now what we are telling, whether price goes up or price comes down, your value of portfolio should be equal. Similarly, what will be the value of portfolio? Delta into low price minus, here you will have low price minus strike price. It might be negative. If it is negative, we don't take it, but as of now some number might be there, so just take it as it is. Low price minus strike price. We just have to simplify, and we need a formula for delta now. So let's simplify this. Keep the delta to left side. This term you take it to right side. How does it become now? Delta into high minus delta into L equals high price minus low strike price becomes positive, and here minus L minus into minus becomes plus strike price. Or let me just keep it as it is. Lower price minus strike price, whole divided by okay, that's it. If I take delta common, you get H minus SP minus L minus SP whole divided by this. If I take delta common, okay, here I should have shown, if I take delta common, I get H minus L, and this term on will come to right hand side. It will be H minus L. If you are able to understand the derivations, good. Otherwise also no problem. Just remember this formula, interpretation of this formula, remembering this formula, application of this formula is important. Derivation, if you know, that helps. This is delta. And you know, usually this becomes 0. Usually, not always, but usually this becomes 0. Because when it is low price, if it is negative, it's not exercised by the holder. You don't get any money. So in that case, it will be high price minus strike price divided by high price minus low price. Actual formula is only so much for delta calculation. Okay. So other way around, people also will say this H minus L formula is there. No, they say S1 minus S2. In some textbooks, sometime institute material give you formula this. S1 minus S2. You know what is S1 minus S2? Higher price, stock price increase S1, stock price decrease S2. That's what they say. S1 is high price, and S2 is low price. And they say numerator C1 minus C2. Okay, what is C1? C1 they say intrinsic value at high price, and C2 is intrinsic value at low price. You can just mention somewhere, please write down. I don't have space, you just write down. C1, C2. Intrinsic value at high price, C2 intrinsic value at low price. Intrinsic value at high price, intrinsic value at low price. Effectively, if you look at formula, how does it look like? Numerator, change in intrinsic value. Denominator, change in spot price. Remember this formula somewhere like this: change in something, change in something. Beta, change in security return by change in market return. That's not the same formula but similar. Rate of change in one variable with respect to rate of change in another variable. In numerator, it is, in this case, change in intrinsic value. Denominator, change in spot price of the underlying asset. I mean, yeah, change in the high price, low price, change in the price of the underlying asset. Okay, so we are still not got you the formula for this, because I told you this value of call option, this is call option premium, VC, but I have not given you formula for that call option premium. Okay, I hope you understand here. Even if not, just remember the formula for delta. That's what we require for computing the value of option. Hope you understood. Okay, I'll go further. Now we have to compute this. Okay, now the value of call option premium, how do we compute? What you have written one sentence only. We should compute the value of call option premium such a way that our portfolio becomes risk free, which means what portfolio we have when the price goes up. If I do present value, that should be my today portfolio. Similarly, when the price comes down, if I do present value, that should be my present value, that is current portfolio, and what should be my option premium. Let's write down. Let's write down. Today portfolio should be equal to present value of portfolio if market price goes up, means it goes to high price. Then your portfolio becomes risk free, because whether it goes up high price or low price, the present value is same as your current portfolio. So your portfolio has become risk free theoretically. So today portfolio is calculated by what we know, which we said now current market price multiplied by delta, number of shares delta, into current market price, and minus the value of our call option premium on one option, premium received. This is the premium receipts, call option premium receipt. Okay, now present value of portfolio. What is the portfolio amount? If market price goes up, what will happen to your shares? Shares will become delta into H. This is the value of portfolio. And what will happen to the option thing? You will intrinsic value of the option we calculated. It will become high price minus strike price will be cash outflow. Call option premium, intrinsic value outflow, high price minus strike price, and present value. So I'll simply do divide by 1 plus r. It can be for e to the power of rt also, if you're doing for continuous compounding. For simplicity sake, I'll say divide by 1 plus r for present value concept. So what should be the amount now? Value of call should be calculated such a way that this you take it right side, this you bring it to left side, or you can vice other way around. So value of call will be simplified by delta into current market price minus delta into H minus H minus strike price whole divided by 1 plus R. In simple words, value of call is difference between today portfolio minus present value of portfolio. That's why on the right hand, if market price is up, if market price is up. So what's the formula look like? Big formula, right? Delta into current market price minus delta into high price minus high price into strike price divided by 1 plus R. Big formula you do. Other way around. I'll give numericals also, don't worry. First you get the formula, and once we go further, we will give you simplified version of it. So you can also understand other way around. That is, today portfolio should be equal to present value of, I'm giving alternative now, present value of portfolio if market price is down, low price, low price. So in that case, how are you going to calculate? Today portfolio delta into current market price. This is the portfolio value today minus value of call into 1. This is the call option premium received today into delta into delta into, this is high price, no sorry, yeah, this is current market price, fine, into delta into low price minus, and when this happens, what will happen, when the low price happens, normally call option market price usually less, it becomes 0. So divide by 1 plus R. So formula becomes value of call is given by delta into current market price minus delta into L divided by 1 plus R. Okay. Now at least tell me, among these two formula, you do you think first formula is preferable, or do you want second formula? Both are alternative. One of them is sufficient while solving problems. Which one would you like to do? First one or second one? You can't say none of the above. Would you like to take the first one, where we do delta into current market price minus delta into high price minus high price into second price divided by 1 plus R, or delta into current market price minus delta into L by 1 plus R? Definitely second one is preferable. Correct? So now what we're going to do, we'll simply write down steps to solve problems and interpretation of that. All these are derivations to give you the lead, how it came up. If you're interested, you can go in detail on this one. But while solving problems, what is relevant? I'm just showing you now. Are you clear? I mean, shall we go to the steps now to solve steps to compute the value of option? Okay, I'll just take out this part. Okay, now simply write down steps to compute the value of option under under portfolio replication approach. Portfolio replication, which is binomial model. First formula, delta. You can say C1 minus C2 divided by S1 minus S2, difference in intrinsic value divided by difference in market price. Difference in intrinsic value divided by difference in market price. And or you can also say in simple words, this C1 minus C2 only will have high price minus strike price, because when it is low price, it's usually 0. So you can ignore it. Low price, you can usually 0 divided by high price minus low price. Simple formula. High price minus strike price divided by high price minus low price. Delta, simple formula. Now, for computing value of call option. For computing value of call option. Simple formula you write down. Today portfolio minus present value of portfolio if market price is down. Last line, last word. Today portfolio minus present value of portfolio if market price is down. Okay, what is today portfolio would mean? Delta, because delta means number of shares. So you can remember delta means number of shares, fractional number of shares, into today portfolio multiplied by current market price, CMP, current market price, minus present value. Present value means divide by 1 plus R for present value purpose. If market price is down means what? Delta into low price. So what about call option? Anyway not exercised. You can ignore. Simple formula. Today portfolio, delta into current market price. Future portfolio, delta into low price, divide by 1 plus R. Anyway, option is not exercised when the market price is down. So you need not write any element towards it. So these are only two formulas you need to remember. Delta, what is the formula? Value of call, what is the formula? Now, any doubts in this one? Okay. You can write one more formula for value of puts, but you don't have to remember the formula. You can compute, but we can do it simply using put call parity theorem. Value of puts can be calculated using put call parity theorem. Once we found out value of call, value of put, we can simply calculate. You don't have to worry about it. What if we took a short position in shares? I told you 4 combinations were there. If you take a short position in portfolio in shares, you take a long positions in options, which means in options you can become call option holder, and accordingly you can derive the formula once more. You can derive the formula under any 4 possible combinations. I have just shown you one method. Sufficient. Hope you got the points. Okay. Let me just tell you the interpretation of delta, but that will understand with help of simple example. One numerical example we'll take along with this one only. We'll apply for this problem. Then we'll go further. Number of shares. Formula again. Delta. C1 minus C2 by S1 minus S2. Difference in intrinsic value by difference in market price. So difference in intrinsic value we take only for high price because low price anyway not exercised. So high price minus strike price by high price minus low price. Okay, let's take one simple numerical example. Let's say spot price is rupees 200, spot price of underlying assets, and they say it can price can go up by 10%, price can be up by 10%, or it can be down by 10%. Only 2 possible situations. And let's say risk-free rate is, let's say price can go up by 8%, price can come down by 8%, Let's say risk-free rate is 5%. 5%. Term, well, let's say 1 full year. Term is 1 full year. We need a strike price, right? Let's say strike price is, for simplicity sake, let's say 205. If these are the terms, what we are going to do? First, delta. High price minus strike price by high price minus low price. Or you can also say that C1 minus C2 by S1 minus S2, whichever formula you want. C minus C2 divided by S1 minus S2. Now, high price means how much? 200 can go up by 8%. So 200 plus 8% means 216, right? Or it can come down by 8%. So 200 minus 8% means 184. So this is going to be high price and this is going to be low price. And strike price 205. So what is, if market price goes up, your intrinsic value will be 216 minus 205, high price minus strike price, that is C1, intrinsic value if the market price goes up. If market price comes down, not exercised, so 0. So C1 is this number, C2 is 0, because if market price comes down, call option not exercised. Intrinsic value becomes 0. Divided by difference between the market price, 216 minus 184. So how much you get? 216 minus 205 is 11. And 216 minus 184, that is 32, I think. So how much you get? Point 0.34375. Okay. So 0.34375. Okay. This means what? Delta 0.34375. It means, implies. Let's write down delta implies. Delta implies risk of one option, one call option is equivalent to the risk of 0.34375 shares. Risk of one call option is equivalent to risk of 0.34375 shares. So which means if I say like call option, one number of shares is 0.34375. Now, you know, fractional number of shares, I cannot do it practically, sir. Okay, for one shares, if you want to do, how many options you need to write down? You can cross multiply and extrapolate. Proportion, it's after all. This is for one share. One share I cannot do it. Okay, one option you can't do it. Multiply and you will get the answer. Like if you do 1 into 1 divided by 0.3475. So how many shares you get? 1 into 1 divided by 0.34375. 2.909. Okay, let's say 2.90, 2.91, let's say. 2.91 call option. 2.91 call option is equal to 1 share. So 2.91 option, I cannot do it. Okay, you multiplied by 100 shares into 100. Now you can say 291 call option is equal to 100 shares. See, the applying in practical life is not a difficult. I mean, converting this into practical, not a difficult thing. So, what does delta represents? For every one share, for every one call option, what is the risk of share in proportion terms, in ratio terms? If you want to convert into round off numbers, you can simply multiply number and you can round it off. You get it easily. Hope you got the logic, that don't have your mind blocked for fractional number of shares that can be easily converted. Here we are representing for one share, so we are getting decimals. So don't worry about that. So delta, it means for risk of one call option, how is the risk of how many shares? This is the delta interpretation. Hope you're taken down. Let me go back to the calculation of value of call option premium. Okay. Value of call is today portfolio minus portfolio, present value of portfolio if price is down. Present value of portfolio when portfolio is down, that is low price. Today portfolio is calculated by delta 0.34375 into current market price. Current market price, spot price 200 minus the present value of portfolio can be calculated by the price if it is down, low price means a 184. So 0.34375 is the number of shares into 184 divided by present value, that is 1 plus 0.05. So 0.34375 into 200, that gives you 68.75. 0.34375 into 184 divided by 1.05. .24, 60.24. So net amounts 8.51, right? 8.51. So basically it means if you have a call option at 8.51, your portfolio becomes risk free. That's what this theorem says, this formula says. So if they ask value of put, use put call parity theorem, you'll be able to find out. Okay, hope you got the one. So under binomial approach, one method of getting the answer is using portfolio replication approach where delta is involved. There is one more approach to get the same answer. In the exam, they can tell you use this particular approach, or they just say binomial model under which you have a choice. You can use either of them. But if they ask you delta and all, you have to follow this approach. Two simple steps only. Hope you got the one. Okay. Shall we go to other method? Then we take up problems. Okay, I'll go further. Okay, now risk neutrality approach. Risk neutrality approach. So here we find out one new terminology that's called as risk neutral probability. How normally we compute probability? Regularly, we calculate probability based on historical pasts. We look at the historical data. We have calculated earlier. Hope you remember. Proportion of sales in 1 day, 2 day, 3 day, like 3 units sold, 5 units sold, like that you compute proportion and you arrive at the probability. Frequency will be converted into probability. So basically, probability is usually calculated by historical data, proportion. But here what do? We will calculate a probability such a way that your portfolio becomes risk neutral, your portfolio becomes risk free assets. Let's write down. Give the heading risk neutral probability. Risk neutral probability. Write down the meaning against that. This is the probability. This is the probability, risk neutral probability. This is the probability. This is the probability computed in such a way that risk neutral probability computed in such a way that the expected return from the underlying asset expected return from the underlying asset is equal to risk free return expected return from the underlying assets should be equal to risk free return. Okay, let me just use the same example I gave you. We will make use of it. Now, what is the thing we calculated earlier in this example only? Either price can go up by 8%. I given either price can go up by 8% or it can come down by 8%. It can be other number also. 8% only, right? Okay. It can be 8 going up, 10 coming down. Any possibility is fine. Let's say price going up by 8%, price coming down by 8%, and risk-free return is 5%. Okay. So we know risk-free return should be 5%. Now, how do you calculate expected return? Please tell me. Basic concept. How expected market price computed, expected intrinsic value computed, expected marks computed, expected speed computed, expected, how it's computed. Basics, average. The value multiplied by probability. Correct? Multiplied by probability. Now, here we have only two possibilities. Either price going up or price coming down. How much probability we don't know, but two possibility only. So a high rise, if market price goes up, you make plus 8% return. And what is the probability? That is, let's say P. That is probability of going up. Probability of going up. High price. Probability of going up. If it becomes high price, you get 8% higher return. Price goes up. Multiplied by, that is plus. Probability of price coming down, you get minus 8. It comes down. Multiplied by what probability? It's coming down. Probability. But can I say 1 minus P? Simple, right? If there are 70% chance price goes up, 30% chance price comes down. Only two possibilities, binomial model. So probability of going up is P, probability of coming down is 1 minus P. Now let's simplify. 8 into P is 8P, minus 8 into 1 is minus 8, minus into minus becomes plus 8P equals to 5. So 8P plus 8P becomes 16P. 8 plus 5 becomes 13. 8 goes to right side, becomes plus. So P equals 13 divided by 16. 0.8125. This is one way of calculating it. There is one more way of also calculating it. Let me show you that as well. We are not going by returns basis. Let's do by price basis. Same thing, but we'll calculate on price basis. Means what? Expected market price. Expected market price is equal to the value of risk-free asset. First, you understand this neutral probability, then we'll go further. I know you might be thinking, why should we calculate this? I'll come to it. It's actually more logical than the previous one. So expect market price, how do we calculate? Either it go up to what? Spot price was how much? 200, right? We had taken. Spot price was 200. So it would have become 216. So the market price can go up to 216. And its probability of going up, P, we have taken. Plus, it can come down. What is the probability? 184. And its probability, 1 minus P, should be equal to what? Should be equal to value of risk-free asset. So if you invest in risk-free asset 200 rupees, on this how much return you should generate? If 200 rupees the risk-free asset investment you do, if this was to be risk-free, how much it should generate? On 205%? Can I say directly 210? On 205%, you get 210. So if 210 is obtained, that means you get the risk-free return. So let's simplify. 216P plus 184 into 1, 184. 184 minus P. How 210? On 205%. I'll show you the arrow also. You can see 205%. It should provide risk-free return. 5% is risk-free return. 200 into 5% is 10. 200 is the spot price. If it provides a risk-free return of 10, 200 plus 10, it becomes 210. Or you can also do spot into 1 plus R, 200 into 1.05, that is 200 plus 1.05, 200 into 1.05, you get 210. Okay, so 184 minus 184 into P, that is 184P equals 210. 260 minus 184, I think you get 32P. And 210 minus 184, that is I think 26. So P equals 26 divided by 32. I think you get the same answer, 0.8125. 0.8125. What do you mean by this? If the probability of price moving up is 0.8125, then the return of the stock and the return of risk-free asset both are same. If the probability is more than this, the stock is likely to give you more return than risk-free return. If the, we'll write all the sentence, don't worry. If the probability actually is less, that means the return expected under this stock is lesser than risk-free asset. So what would be your recommendation? If you expect this, you invest in risk-free asset itself. Okay, you write down in sentence, you get more clarity. Then we'll do the derivation of this by way of a formula. Write down. Probability of 0.8125 implies probability of 0.8125 implies, probability of 0.8125 implies if the chance of price going up, if the chance of price going up is 0.8125, meaning 81.25%. If the price of going up is 0.8125, P, price of going up is 0.8125, then return from the underlying, is equal to return from the risk-free asset, is equal to return from the risk-free asset, is equal to return from the risk-free asset. In other words, if the probability of price moving up, is likely to be more than 0.8125, if probability of price moving up is likely to be more than 0.8125, more than 0.8125, then the underlying asset is beneficial to invest. I mean, the underlying asset is beneficial. Then underlying asset is beneficial for investment. Underlying asset is beneficial for investment. Else, next full stop, next sentence, else, meaning otherwise. Otherwise means what? If the probability is less than 0.8125. Else, investing in risk-free asset is beneficial. 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 Okay. I hope you got the interpretation of it. Now let's come to the formula of it. Risk neutral probability. What if more than two rates of increase and their probabilities are given? We are discussing under binomial model. Portfolio replication approach and risk neutrality approach. We are discussing under binomial model. So binomial model, we will have only two possibilities. We are only discussing under that. If practically we can have more than two possibilities, but we are not discussing that. So we will not dilute our discussion. The basic assumption of these discussions is we will have only two possible price, either high price or low price. Binomial model. Okay. So let's come to the price now. Derivation of risk neutral probability. Risk neutral probability. How do we calculate? So expected market price should be equal to the value of risk-free asset. Expected market price, either high price and price probability of moving up. H means high price and P is probability of moving up. And everywhere going forward, I'll assume P means probability of moving up. There, please don't ask me doubts. Sir, how will you tell P is up only? P can be down also. Now itself making it clear. In all the things I'm going to discuss later, if I just write P, it means probability of moving up. That is the interpretation. All formulas are derived based on this assumption. Plus price moving down. So low price into 1 minus probability. Because probability moving up, 1 minus probability means probability of moving down. Should be equal to value of risk-free asset. Let's say spot price into 1 plus R. Or you can just say future value. Or let me just say future value. This is equal to future value. Spot into 1 plus R. Risk-free rate of interest. R is risk-free. Okay. Now just open the brackets. H into P plus L into 1 L minus L into P LP minus this is, let's say, future value. Let's group the probability. HP minus LP equals F minus L. P you take it common. H minus L equals F minus L. So probability is F minus L by H minus L. So in fact, the formula of delta is very similar. The denominator is same. There also H minus L. Here also H minus L. Numerator is different. There high price minus low price. Here future value minus low price. So if you can compare the two, you can remember both. Interpretation is different, of course, but a formula is similar. So in this approach, our first step is always to compute risk neutral probability. We'll do summary later. Fine? Okay. Now let me go for the value of option. Very simple method to value of option. Hope you have done till here. Okay. Now, value of, let's say, call option. Very simple concept. On expiry and today. And today is what you are paying option premium, right? Today you are paying option premium. Today cash flow is option premium. And on expiry, you will have intrinsic value. Now, intrinsic value, now we will calculate based on two prices. Based on two price. What are the two price? It might be high price or it might be low price. Strike price is SP. So what is the intrinsic value we get? If the price goes up, high price minus strike price. If the price comes down, low price minus strike price. But this will usually be zero. Usually be zero in call option. In put option, some amount can be there. But in call option, this will usually be zero. But this is two numbers. How do we convert these two values into one value? Any idea? Average. How do we convert these two values into one number? If two numbers are there, in one subject I got 30 marks, in other subject I got 35 marks, average will take it. How do we convert this into average? Applying probability, expected value. We multiplied by P. And here we multiplied by 1 minus P. P represents risk neutral probability of going up. Risk neutral probability of price going up. And if I add both, I get expected intrinsic value. Expected intrinsic value. Like high price minus strike price into probability plus low price minus strike price, which usually will not be exercised, but still formula will write down into 1 minus P. And this is intrinsic value, but premium will take today. How do we convert from expiry date today value? How do we do from the expired intrinsic value to today? We will divide by 1 plus R or e to the power of RT, basically present value. And that is what is theoretical value of call option premium. That is what is supposed to be option premium, supposed to be value of call. So we compute the expected intrinsic value and you compute the present value of it. I'll give you formula in steps, don't worry. But you understand the logic of overall calculation. Okay, hope you got the points. Let's write down the steps. Okay, so steps in risk neutral approach. Step 1, probability. F minus L, okay, risk neutral probability. Risk neutral probability. That is probability equals F minus L by H minus L. Please understand, P means probability of price up, probability of price going up, and obviously 1 minus P represents the probability of market price going down. Price means price of the underlying asset. Step 2, value of option. And to remember this formula, one simple sentence is there. Remember this, it is present value of expected intrinsic value. That's all. Present value of expected intrinsic value. Understand three process. Intrinsic value first, compute expected value second, compute present value third step. So this, if you remember, the formula is there in your hands. Present value of expected intrinsic value. Intrinsic value first, then you do expected value of that, then you do present value of that. What is expected value means? What is intrinsic value? High price minus strike price is one intrinsic value. Low price minus strike price, another intrinsic value. We need expected value, so multiplied by probability. Here you multiply it by 1 minus probability. Sum it up, and most probably this will be 0 because the options will not be exercised most probably. And so we did intrinsic value, we need expected intrinsic value, then you divide by 1 plus R. If E value is given, we divide by e to the power of R, and that gives you the value of call. Similarly, we can also calculate value of put, or you can also do it using put call parity theorem. Both works. And what is the intrinsic value of put call parity theorem? I mean, what is the intrinsic value of put option? Sorry, what is the intrinsic value of put option? Basic intrinsic value calculation. For a call option, it is market price minus strike price. For a put option, reverse, strike price minus market price. So here it is strike price minus high price into P plus strike price minus low price into 1 minus P divided by 1 plus R. Again, this strike price minus low price is likely to be 0, because when the market price goes up, put option likely to be not exercised. And you can also go for calculation of put call parity theorem. That also works. No, you cannot say never exercise. Low price does not mean low price is below spot price, not below the strike price. See, current today price can be 100. It can go up to 110. It can come down to 90. But strike price can be 85. Now, if the market price comes down to 90, can I not say that call option will still be exercised? It depends on what is the strike price, right? Strike price can be below low price also. I mean, theoretically, I'm telling. Most likely not. Most likely it will be in between that. But theoretically, I cannot say categorically it will not be there. So most likely, when the market price is less, it is not exercised. But in some cases, it can happen. Previous slide is not there. I took it out. Previous slide not there. I'm just rewriting one after the other. Okay. In the same example earlier, let's apply this formula. Let's see if we get the answer. The same example earlier, what we got. Okay. Same example earlier. What are the numbers we had got? Like a spot price, I think we got 200. High price, I think it is 8% up. Means 216, or 8% down, it is 184, and risk-free rate we took 5%. Can you please tell me what is the strike price we have taken? 205, is it? Something like that? Strike price 205, right? Or 204, 205. Okay. Let's solve this same thing under risk neutral approach. We should get the same answer. So step 1, risk neutral probability. Probability F minus L by H minus L. Oh, they will actually give one more formula also. I should give institute as a formula. I'll give it to you. I'll give it to you with the logic. I'll tell you. As of now, we'll just write this. Then another notation what institute gives you, that also share with you. Don't worry. So a future value, today value 200, it can increase by 5%. So 200 spot price into 1 plus R. It can increase by risk-free rates. Future value is the value of risk-free asset. Minus low price 184 divided by high price 200 minus no, high price 216 minus 184. So 210 minus 184 divided by 32. .8125. Oh, we already calculated, no? Correct. This number, same example, we already calculated while discussion. We already got this number. No problem. No problem. Okay. Now, just mathematically observe one more thing. Here, 200 into 1.05. Very good. Minus 184. How we got? On 200, we subtracted 8%. That is nothing but on 200 into 1 minus 0.08, right? 200 reduced by 8%. So 1 minus R, like a depreciation, is coming down. 200 on that 8% we subtracted. 1 minus R. Denominator. How we got 216? We increased by 8%. That is 200 into 1 plus 0.08 minus 200 into 1 minus low price 0.08. So everywhere if I take 200 out, what remains? 1 plus 0.05 minus 1 minus 0.08 whole divided by 1 plus 0.08 minus 1 minus 0.08. Will you get the same answer? 1.05 minus 0.92 divided by 1.08 minus 0.92. Please see if you get the same answer as 0.8125. We get the same answer, right? Okay. Now this one that is calculated directly in percentage terms. Everything in percentage terms. So probability based on percentage terms. Risk neutral probability based on percentage terms. So without worrying about the price, based on percentage terms only you can calculate. And that formula is given by institute. They give you like this: R minus D divided by U minus D. So what does this R represent? R represents 1 plus risk-free rate. D represents 1 minus percentage down. U represents 1 plus percentage up. That's what we have done here. 1 plus risk-free rate. 1 minus percentage down. 1 plus percentage up. 1 minus percentage down. R minus D by U minus D. Probability, risk neutral probability. Sometimes they give you using this formula. Okay, let's go for step 2. I told you simple formula to calculate. Remember the sentence. It is present value of expected intrinsic value. 3 terms: present value, expected, intrinsic value. Present value of expected intrinsic value. Let's write the formula once. Value of call equals high price minus strike price into probability plus low price minus strike price. Most likely it will be 0 into 1 minus probability whole divided by 1 plus R. In this case, high price, it can go up to 216 minus strike price, that is 205. Probability 0.8125. Now, if the price comes down to 184, strike price 205, market price is less, anyway call option not exercised, 0 I'll write. Second case, low price minus strike price 0, I don't write negative. Into probability, 1 minus probability. What is 1 minus 0.8125? 0.1875. I mean, it does not matter, anyway 0, but still writing for reference. Whole divided by 1 plus R, that is 1 plus 0.05. If e power was there, continuously compounding would have done. Please calculate this and see whether our number matches with the previous method. Earlier we got how much? 8 point something, right? $8.51. Earlier also we got approximately same answer. Some rounding off might be there. Yeah, 8.51 only, right? Earlier also. 8.51. So value of call. Similarly, we can compute value of put, or you can also do put call parity theorem. Both ways answer works. Okay, so both the method gives you the same answer. In the examination, if they say just binomial model, you can choose either of them. If they use portfolio replication approach, first formula to be applied. If they tell you use risk neutrality approach, second formula to be applied. If they tell you compute delta, portfolio replication approach only should be applied. Ultimately, both give same answer. Many people prefer this method. You can also do it. Depends on your preference. But if they ask you delta, you have to go for the previous method. Okay, very good. Okay, so come to this problem now. From the information below, compute the value of call option and put option using binomial model. Spot price, strike price, future selling price may be 90,108, term 3 months, interest rate continuously compounded given e power 0.03, 1.03045. Let's calculate using binomial model. So you can do risk neutral approach, or you can do delta approach, that is portfolio application. Let's do under portfolio application now. Under portfolio replication approach, two steps. Step 1, delta calculation. Hope you remember the formula. You can do C1 minus C2 by S1 minus S2, or you can also say like this, which is high price minus strike price, because anyway intrinsic value would be 0 when it becomes low price, divided by low price, high price minus low price. What is high price? It may go up to 108. Strike price, it may be 97, divided by minus 0. If the market price is becoming lower price 90, it's not exercise, 0. So C1 is this, C2 is 0. High price minus low price, high price 108, low price 90. So what is the delta coming to? 108 minus 97 divided by 18. 0.611. Let's say 0.61. That means what? For every one call option, it is equal to 0.61. Risk of one option is equal to risk of 0.61. So risk of one option, one call option is equal to risk of 0.61 shares. 0.61 shares. Step 2, value of call is calculated by present today portfolio minus present value of future portfolio. So today portfolio minus the present value of portfolio when market price is down. We can also understand and calculate when the market price is up. That also we discussed in the basics, but that formula is slightly bigger, so we don't do it. But answer will be same only. So it's preferable when the market price is down, formula is short. So today portfolio is calculated by delta, number of shares, into current market price, minus portfolio when the market price is down means delta into low price, and present value means we divide it by 1 plus R. But in this case, continuously compounded, so we can divide by E here. So delta, we can divide by e to the power of R. In this case, we have the formula. So delta is 0.61 into current market price, spot price 100, minus delta 0.61, low price, it may be 90, divided by e to the power of rt. E power r, what is e power r? E power r 0.12 into time period. What is time period? 3 months. 3 by 12. So e power 0.03 you get, which is what they have given. So let's use directly 1.03045. Simplify and see how much you get. 0.61 into 100, 0.61 into 90, divided by 1.03045 minus 61. 7.72, I think. Okay. Let's also calculate using value of put option. Let's also calculate the value of put option. If you want, I'll just give you the formula for that. Then we'll also do put call parity theorem. Make sure you get it till here. Okay. Okay. Value of put option also just give it to you. If you want, I'll just show it to you. Value of put option. Overall formula is same. C1 minus C2 divided by S1 minus S2. In this case, there we did high price minus low price, but here it will be, high price minus strike price, but it will be reverse. Strike price, this one will be 0, first one, minus strike price minus low price. The low price minus strike price. Strike price minus low price. When it is high price, put option not exercised. That's why. Divided by S1 minus S2. So this is 9. Strike price is 97. So 97 minus 90 minus you get actually whole divided by S1 minus S2, which is 108 minus 90. Just tell me how much you get. 7 by 18. .388, let's say 0.39. You get minus 0.39, but that is the delta of put option. Actually, you can also calculate like this. We got delta of call. Delta of put can be calculated by like this. Delta of call or delta of put can be calculated by delta of call minus 1. We calculate delta of call to be how much? 0.61 minus 9. That also give you that number minus 0.39. That minus you can ignore because delta put option will always be negative. And if you want value of this is not sorry, not value of put. This is delta of put option. Sorry, delta of put option. Value of put option can be calculated by today portfolio minus portfolio if it goes up. Present value of portfolio if it goes up. Market price is up. Sorry, market price is up. Yeah, opposite. Because down means up means not exercised. Down is exercised. So today portfolio delta 0.3839 into current market price 61 minus present value of portfolio, that is if it is up, so 100 delta 0.39 into market price is up, that is 108 divided by 1.03045. See how much you get. This is not 61, sorry, spot price 100, spot price 100. So this will be 39 minus 0.39 into 108 divided by 1.03045. 40.87. That is negative because we got the negative beta. No, that's why 40.87. Negative ignore. See, here also we ignore negative, here also ignore negative. Minus 1.87, you ignore it. That's basically 1.87. 1.87. Okay. Value of put. Actually, you should do reverse. The present value of portfolio minus today portfolio, you get the positive answer. Or if you do minus here, minus 0.39, this is also minus 0.39, you get the answer because both are negative, right? Negative delta you get. Then also you get the answer. But anyway, that is too much of complication. This is one method. I really don't recommend this method in exam. But for some of you who want to know formula here, I've given you. Then using put call parity theorem, we can get the answer easily. So I'll just write it here. Using put call parity. Okay, I'll just write it below. Hope it is done till here. Shall I take this part out? Sometime later we get the same problem, but here there we solve it under risk neutral approach. We prove we get the same answer. Hope you got it. Okay, let me do under portfolio put call parity theorem under PCPT. Value of call plus present value of strike price is value of put plus current market price. Value of call we calculated. How much was that? 8 point something, 7.7. Okay, 7.72 plus present value of strike price 97 divided by 1.03045 equals value of put. We need to calculate current market price, spot price 100. So 7.72 plus 97 by 1.03045, 94.133. 94.13 minus 100. So value of put equals 1.85. I think that round off, that is due to rounding off in reasons. So difference 1.85, there we got 1.87, I think. The difference due to round off, that you don't win. Difference due to round off. Had you taken more decimal, the answer would have been more closer. Okay, let's go further. Okay, so come to this problem. Come to this problem. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at 600 spot price. He expects the price of share may go up to 780 or may come down to 480, high price, low price, in 3 months. THRE, be careful when they give information in words. He expects that the price of the share may go up to 780 or down to 480 in 3 months. The chance of occurring the variations are 60%, 40% respectively. He only has given, that is his estimation. A call option on ABC's Limited can be exercised at the end of 3 months with a strike price of 630. So strike price 630, 3 months time period. What combination of share and option should Mr. Dayal if he wants a perfect hedge? Now please tell me, what combination, share and option to do a perfect hedging? Are they talking about binomial model, or are they talking about risk neutrality model or a portfolio replication approach? In what combination, share and option are mixed to make the portfolio risk free, to do a perfect hedging? Which method? Binomial method? Binomial is fine. Risk neutral or portfolio replication? In which case we mix both and we make the portfolio risk free. In my question only answer is there. You mix the portfolio to make the portfolio free, risk free, which means it's portfolio replication approach. And in what combination you have to mix, that is derived by delta, because for every one option, how many shares you need to take position, in what ratio you have to mix the shares and options. In what ratio you have to mix the shares and options will be given by delta. In what ratio you have to mix the shares and futures is given by what? In what ratio you have to mix portfolio with the index futures? In what ratio you have to mix the both so that overall portfolio becomes zero? What is going to be calculated for that? I'm just taking back a little bit backwards. We have a portfolio of shares, we have index future. In what ratio it has to be mixed? What do we calculate for that ratio in futures? How do we decide how much position to take on index futures? Okay, for the sake of asking the question, which is a mistake from my side, I'll answer it. It is called as beta. Portfolio into beta. That is the position we take it in index futures. I'm not asking full formula steps. That beta term also you don't remember. Amazing. So the point I was trying to tell you, if you can remember easily, in futures we take the help of beta, in options we take the help of delta. In futures, it is portfolio amount, we multiply by the index, we multiply by the portfolio beta. That is the position we take it in index futures. And in case of option, if you want a perfect hedge, we take the position in the options itself to the extent of their delta. Anyway, sorry for asking the question, I'll go further. What should be the value of option today? Risk-free rate at 10% per annum. What is the expected rate of return on the option? Okay, what combination of share and option to make it risk-free portfolio? So to do perfect hedging, for a perfect hedge, in option, compute beta, compute delta. Delta formula, delta of call option, we can say C1 minus C2 by S1 minus S2, or high price minus strike price by high price minus low price. It may go up to 780. It may, strike price is 630. High price is 780. Low price is 480. So you get 150 by 300, 0.5. So this implies, again, I'll not ask you, don't worry, I will tell you. Risk of one call option is equal to risk of 0.5 shares. So in what combination you should make a combination means for every one share, for every one option, you need to have a 0.5 shares. So if you want for every one share, what should be the combination? So if I say call, if I say shares, call option, for one call option, you will have 0.5 shares. If you want it for a one share, how many calls to be written? Cross multiply 1 into 1 divided by 0.5, you get 2. So for every one share, long position, you need to have 2 call option. Short meaning 2 call option writing to make risk-free portfolio. I'm discussing all these things under the assumption you know the meaning of call option, put option, but I really don't know whether I can make that option, I can make that assumption. But I'm sorry, I don't have any choice. I have to assume that you know the meaning of call option, you know the meaning of put option, you know the meaning of call option writing, you know the meaning of put option writing. I'm assuming that. I'm sorry for that, but I don't have any choice. I know you would like me to revise that also in every problem, but I don't have any choice, so we have to move on with the time. Okay, so that's the first part of the question. What combination of the share and option should Mr. Dayal select if he wants a perfect hedge? Now, what should be the value of the option today? Now, because we calculated delta value, let's go with that only for the purpose of calculating the value of delta today. Or you can also go with the method of wrong method is neutrality model, but we don't require. So let me go for second part of the question. Value of call option. I mean, when they say value of option, you can say call or put. In this problem, they are talking about call. So you have to understand it is about call, because again, I'm telling, because this is the first paragraph and third part of the question, the second part of the question, you might have forgotten by you come to second part. So I'm clarifying it. So value of call option. I'll give you the formula. Value of call is calculated by today portfolio minus present value of portfolio if it goes down, when market price is down. You can also do when the market price is up, but in that case the formula is slightly more bigger. So let's use this formula. Today portfolio is calculated by delta into current market price, spot price, minus when the market price is down, you get delta number of shares into low price and present value. So divide by 1 plus R. So delta we calculated 0.5. Current market price, spot price 600, spot price 600, minus delta value. Delta value is 0.5. Low price, when the price is down, 480, divided by 1 plus R. No E value, so compounding, continuous compounding not required. 1 plus rate of interest 10% per annum, 0.1. And this is only for 3 months, 3 by 12. Okay, where is it given 3 months? It is given here at the end of 3 months. That's what they're asking. Here also they said 3 months, 3 months. 600 into 0.5, which is 300, minus 0.5 into 480, 240, by 1 plus 0.1 into 3 by 12 means 0.025. 240 by 1.025, 243.14. So 300 minus 2, 34.14. 146, let's say 15. We get 65.85. So what should be the value of option today? Calculated. This is the theoretical value of option premium. Now we don't have any information on actual premium. So let's say this is equal to actual value also. We don't have information of price separately. This itself also will be equal to the actual price. Okay, let's go for third part of the question. What is the expected return on option? Expected rate of return means what? How much you invest and how much is your return. Then return on investment you calculate. Investment takes place today. The return takes place on expiry. So today what you pay is option premium. And expiry what you get is intrinsic value. They said that there are two market price. So we can't compute one intrinsic value. We'll compute two intrinsic values. So we get expected intrinsic value. Or we can compute one intrinsic value, what is the return? Another intrinsic value, what is another return? Then you can take a weighted average of that. That also works. Okay. Now regarding option premium, actual value not given. So let's take the theoretical value of call was we just computed 65.85. Expected intrinsic value, it may go up to 780 and it may go up to 480, down to 480, and strike price 630. So formula of call option, intrinsic value of call option, I'll tell you. The formula is market price minus strike price. Here market price means high price, so 780 minus strike price of 630, and 480 minus strike price of 630. And here you get 780 minus 630, that is 150. And this negative we don't write, we make it as 0, because option will lapse. When the market price is less, call option will lapse. Now 150 and 0. How do we convert this into expected intrinsic value? We multiply it by probability. So we multiply it by probability, they have given 60%, 40%, 0.6, 0.4. Now these two probabilities are not risk neutral probabilities. Because if you do risk neutral probabilities, the present value of this will give me value of call only. But it is not going to be that, because these 60-40% are not risk neutral probability. These 60%, 40% are expected, whatever their opinion, estimation, their prediction. See what is the return you are going to get. If it is going to be risk neutral probability, if you do like this, then your rate of return will be risk free rate under risk neutral probability. Because what is risk neutral probability? What is the probability such a way that your return should be risk free? But here it's not the case. Okay, 115 to 0.6 and 0.4. So you get this plus. If I do, I get 90. So return, rate of return, I'll do like P1 minus P0 by P0 into 100. 90 minus 65.85 divided by 65.85 into 100. .67%. If you invest only in options, you can get 36.67% expected rate of return in the option. Okay. In this problem, suppose if I have calculated the risk neutral probability, at that value, what would have been your rate of return? Just for your verification purpose, just for conceptual purpose. I know I've explained, but let me just prove it also. Just situational one, hypothetical one. If risk neutral probability were to be calculated, if risk neutral probability is applied, then what would happen? Just for our referential purpose, risk neutral probability P is given by F minus L divided by H minus L. Future value, spot price 600 into rate of interest 10%, but for 3 months. So I'll do 1 plus 0.025, because 10% for full year, for 3 months means into 3 by 12. You get 2.5%, 0.025, minus low price 480 divided by high price 780 minus low price 480. 0.45. So if I use this, so probability of going up. So probability of going up is probability of price going up is 0.45, and probability of market price coming down is 1 minus 0.45, 0.55. So instead of 60%, 40%, had I applied 45%, 55%, what would have happened? Let me see. Expected intrinsic value would be either I get 780 minus 630 multiplied by 0.45, or 480 minus 630 multiplied by 0.55. This is 150 into 0.45. This is anyway 0, not exercised, into 0.55. So 150 into 0.45, 67.5. And today you invested 65.85. Option premium today, $65.85. So 65.85 became 67.5. So what is the rate of return if I calculate? 67.5 minus 65.85 divided by 65.85 into 100. You would have got 2.5%. And what does the 2.5 represents? That would be your risk-free rate. Why risk-free rate? Because this option premium is calculated based on risk-neutral probability. Basic implied assumption under this option premium is you get risk-free return. And that's what the probability we have used, 45, 55, risk-neutral probability. But actual probability is 60%. So 45% is risk neutral probability, but actual probability, their expectation, 60. Since you're expecting high, you got a profit. The 36% return. So it's all about whether your expectation comes true or not. So how much ever we discuss, ultimately it's all about whether your expectation comes true or not. Your view, whether price goes up, coming down, does not change volatile, whatever may be your view, you have to take a view based on all the circumstances and news available. If your expectation comes true, you make profit, else you make loss. So the stock market is all about making estimations, projections, predictions. There is nothing which can provide risk-free return, guaranteed return. Only under arbitrage it's possible, but that after the computer have been invented, the algorithm will give you the situations automatically. So that identification is very, very minimal. So if you want to be profitable in stock market, you should track the stock market so closely and you should have so much of knowledge. So your prediction becomes more accurate than the number of times where you lose. Okay, let's go further. Hope you got this question. This is asked in the exam quite a few times. This variety, and this is about option valuation. Let's read. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at 600 each. He expects that the price of the share may go up to 780 or may go down to 480 in 3 months. The chances of occurring such variations are 60% and 40% respectively. A call option on the share of ABC Limited can be exercised at the end of 3 months with a strike price of 630. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of option today if the risk-free rate is 10% per annum? What is the expected rate of return on the option? So quite a few things are there. Again, this problem, I would like to go beyond what is asked in the examination. It's basically a binomial model problem. And you know, binomial model, two methods are there. One is portfolio replication approach, other is risk neutrality approach. And this problem is portfolio replication because they are talking about perfect hedge and all. I'll explain what is that perfect hedge situation. When they ask you such perfect hedge, it is based on delta calculation, which is portfolio replication approach. But I will do the problem also on risk neutrality approach logically and using formula so that you're able to reconcile how the two method works in a same problem. In the exam, one method is sufficient. But here you have to follow portfolio replication approach. So I will go a little bit beyond what is asked in the examination. So stay with me till the end. Okay. First, let's write down what is current data available. Currently selling at 600 rupees. Okay. Spot price. I can say 0. Spot price. Underlying asset 600 each. He expects the price of the share may go up to 780 or may go down to 480 in 3 months. So after 3 months, this is today. After 3 months, there are two chances. It may go up or it come down. It may go up to rupees 780 or it may come down to 480. To 480. And chances of occurring, that will come to a little bit later, the probability part of it. A strike price of 630. Okay, strike price of 630. This is market price. Okay, this is market price on expiry. And what is strike price? Strike price is 630. Okay, now in which combination the share and option should Mr. Dayal select if he wants a perfect hedge? Again, this is a call option. Okay, call option. Perfect hedge. That means we have to calculate delta to create perfect hedge. To create perfect hedge means make portfolio risk free. Make portfolio risk free with combination of the share, which is portfolio, and call option. And that is calculated by delta. Delta of call option is calculated by C1 minus C2 divided by S1 minus S2. Basically means spread in call option or spread in intrinsic value of call option divided by spread in market price. Is like delta beta, change in security by change in market, rate of change in one variable with respect to rate of change in another variable. Now what is the intrinsic value in this case? Now 780, 630. Do you think market price is, call option exercise? Yes, no. When the market price is more, call option exercised? Yes, it is exercised. And how much? Intrinsic value 780 minus 630, that is 150. And if market price is 480, not exercised. Market price is less, call option not exercised. So not exercised. So what will happen to that? The call option will lapse. It becomes 0. So what is the spread now? The spread in the call is 150 minus 0 divided by spread in the market price 780 minus 480. So 150 by 300, I think you get 0.5. That is delta. Delta of 0.5. How do you interpret? One way of interpretation, if market price changes by 1% or 1 rupee, you can say 1 rupee. If market price change by 1 rupee, the intrinsic value, option value will change by 0.5, or we can say delta of call 0.5. Also we can interpret risk of 0.5 shares equals to risk of 1 call option. This is delta, fractional shares. Some people also call it as fractional shares. Fractional shares. I'm trying to explain in detail with the logic. And at the end, I'll show you how can you solve this problem in fraction of few minutes. And that also I'll quickly show it to you. Don't worry. First, try to understand the logical part. Also, write it down. So delta can be understood as if market price changes, by how much option value, intrinsic value, option premium will change. Or you can also say if what is the risk of one share, risk of one call option is equal to risk of 0.5 shares. Which means portfolio will be risk free. Portfolio will be risk free. Risk free with one call option and 0.5 shares. Of course, on shares, if you take a long position, on call option, you should take a short position. Portfolio will be risk free for one call and 0.5 shares, because both of the risk are equal. I just told you 0.5 share is equal to one call option. Risk is same. That's the interpretation of delta. And one call and 0.5 on, you take one long position and you take short position. Both risk is same. So you take long and short, one asset, one liability. You're creating opposite position. If you mix them both, you understand both risk. One increase, other decrease by same amount, because risk is same. That means overall the portfolio will not move, means it becomes risk-free portfolio. In other words, we can't have 0.5 shares, right? I can multiply it by 2. If I want it for one share, can I for 0.5 share, one call. For one share, double it. No, two call. Understand? So I'll write in the next slide. Hope you can. Hope you have written till here. Okay. Done. Okay. Let me rewrite now. What is this? Finally, all these things what you've written. Ultimately, what is going to be there? Let me write it now. Portfolio will be risk free, or portfolio will achieve perfect hedge. Will achieve perfect hedge when what combination, that is one share and two call options. Hope you understand. I just multiplied by 2. 1 is to 0.5. I doubled it. So 0.5 became 1, 1 became 2. Cross multiplication. One share and two call options. On one share, you have taken long position, and two call option, you short. That means you write. So on share, you make a investment, and on two call option, you will receive premium. How much supposed to be the premium is what we are going to calculate. Okay, now, okay, now after 3 months, after 3 months, now market price might increase. Market price increase to what? What is expecting? It might go to 780, or market price might fall to 480. Two situations we're discussing. And what is your portfolio consisting of? Your portfolio consisting of, you can say one share and two call option, or you can say 0.5 share and one call option. Both way you can understand. I'll go for fractional only. Your portfolio consisting of, like the way what I've written here, your portfolio consisting of zero point 0.5 shares and one call option. So that my answer directly come to value of call. And you can also do one share and two call option. Then later, whatever answer you get, you should divide by 2 for value of one call option. Okay, so your portfolio is having 0.5 share and one call option. Now for 0.5 shares, what will be the value becomes now if market price becomes 780? So 780 into zero point 0.5, this becomes 390. Yeah, 390. Now, what will happen to call option? Okay, call option at a strike price also. That also I should write down. At a strike price of, how much strike price? 630. At a price of 630. Now think slowly here. When the market price is up, is the call option exercised? Market price 780, call option 630. Market price is more, call option exercised. So what is the intrinsic value will become? 780 minus 630, in fact we already calculated 150. But please tell me, this 150 is a profit for whom? For option holder, right? Option holder like this profit, intrinsic value will be profit, but you are a option writer. Call option short means you are call option writer. You are a call option writer. So as a call option writer, you end up loss. That is market price 780 minus 630, intrinsic value 150, but that is going to be loss of 150. So what is your net portfolio amount then? 390 is the value you are having in shares. 150 is the loss you're having in call option loss because you're a writer. Writer don't like option to be exercised. Writer likes option to lapse so that he can pocket entire premium. But here, call option market price is more exercised. But it is the writer point of view. Writer has to incur loss. You can say it's an option, no? You can say I will not exercise. Writer don't have a choice. Writer should oblige. Holder has the right. Writer has the obligation. Both people cannot have the right. One person has right, other person will have obligation. So it's a profit for the holder. Writer cannot object. He has to incur loss. For this only he will receive premium. He is the receiver premium at the beginning. So what will be the portfolio value? 390 minus 150, 240. If the market price comes down, what will happen to the portfolio value? 780 is the, not 780, 480 you have. Market price comes to 480. You have 0.5 shares, that becomes 240. That becomes 240. And what will happen to the call option position? Intrinsic value. I'm only talking about intrinsic value. Now, when the market price is less, call option not exercised. If call option not exercised, that means its intrinsic value becomes 0. That's what the writer likes actually. So what is the value of portfolio? It is 240. That is what is called as risk-free portfolio. Perfect hedge. Market price goes down or market price comes down. Market price goes up or market price comes down. The value of portfolio is exactly the same, which is 240. Now, what is the cost of this 0.5 shares? What is the cost of this 0.5 shares? Today market price 600 rupees, right? 600 rupees. So what is the cost becomes? Anyway, and what? How much amount this premium you should receive? I'll repeat this part once more. This what you calculated is after 3 months. Correct? After 3 months, if the market price goes up or market price comes down, uh, the portfolio value will remain same. Now for this to achieve, today portfolio also I have to see what is the amount. Today portfolio will comprise of two things. One is on share, I made an investment, and on call option I receive premium. Now can you please tell me, when I receive premium, what will happen to my portfolio value? You understand? I have invested in my shares. I receive some premium. So what will happen to my cost? My net outflow will reduce, right? Getting my point? I have invested 1 lakh to purchase the shares. I received a premium of 10,000. So my net investment is 90,000. If I mix both, if I take both of them as net investments, see, I long on 1 lakh. I short on 20,000. Net 80,000 net amount. So on share, per share is 600. That is 600 into 0.5 because I'm taking at 0.5 shares. So its value becomes 320. Sorry, 300. Why 320? 300. 300. And how much premium I need to receive? I'll say value of call, VC. What will be net amount? Can I say 300 minus value of call? As I just explained, on share, I took long position. I paid the amount to get the shares. On the call option, I took a short position. I received premium. So net amount 300 rupees. The outflow value of call. I'm a writer. I receive premium inflow. So net investment 300 minus the value of call option premium. This today value, this 240 is after 3 months. If it has to be risk free, this should adjust ideally for 1 plus R, that is time value of money. And if it is a continuous compounding, I'll do E per RT. So what will be the equation will become 300 minus value of call into 1 plus, what is the rate of interest? Rate of interest, risk free rate is 10%. And it is for 3 months. So I'll do 10% into 3 by 12. 0.10 into 3 by 12. So this into 1 plus R, this should give me 240. You simplify that value of call, that should be the premium to be received, so that today value and after 3 months value both are equal. I'll simplify in the next slide. So please you write it till here. Okay, done. Let's simplify. 300 minus value of call into 1 plus 0.010 to 3 by 12. So I'll say 0.025 equals 240. Open the brackets. So 1.025 into 300. 1.025 into 300. 307.5. Or actually I can take this 1.025 to right side. 300 minus value of call is 240 divided by 1.025, which is equal to 234.15. So 300 minus 234.15 is a value of call. So value of call 65.85. Okay, this is what Institute has solved in a big way. Now I will try to give quick answer. What I will recommend, definitely you can present this in exam. Okay, now what I'm writing is quickly to solve the problem in exam. I'll say for exam. You can follow this step quickly. Portfolio replication approach. Portfolio replication approach. Two simple steps here. Two simple steps. First step, compute delta of call. I will tell the formula. It is high price minus low price, or high price minus strike price by high price minus low price. Second step, value of call is difference between today portfolio minus future present value of portfolio at lower price. That's all the steps you require. High price minus strike price. What is high price? High price, it may go up to 780. Strike price 630. divided by high price 780, low price 480. This is 150 by 300. You got 0.5. Delta is done. 2 seconds. How come this number and previous number is same? In fact, H minus L is same as difference in market price, S1 minus S2. And what is this numerator? High price minus strike price. That is what is call option intrinsic value. No, 780 minus 630. I have not done C2. Why? Because when market price is less, call option not exercised. So as well as I can ignore it. 0, right? As well as I can ignore it. So anyway, this formula you get easily in case of call option. If it is put option, strike price minus low price. Or you can do low price minus strike price only. You get negative number. That's what the delta is supposed to be. Okay. Now, value of call. Today portfolio. How do you calculate today portfolio? Delta of call into current market price minus present value of portfolio at lower price. That is the delta of call is number of shares you get. Delta multiplied by low price present value divided by 1 plus R. So why it is only at lower price? Because even if you take higher price, answer will remain same. You see, we checked it. 240 only you will get it. Okay. What is delta? 0.5 into current market price, which is 600 minus delta 0.5, low price 480 divided by 1 plus R, 1 plus 10% for 3 months into 3 by 12. That is 0.5 into 600, 300 minus 0.5 into 480, 240 divided by 1.025. So 240 by 1.025 minus 300, you get 65.85. That's all the answer. I hope this is much easier. This is what I have in my textbook also. Portfolio replication approach. In 2 steps, your answer is completed. We have calculated delta to create a perfect hedge, one chart, intrinsic values, E1 minus E2, S minus S2, then interpretation of delta, then you have one portfolio today, after 3 months, a market price up, a market price is down, then compare. Okay, if you want, you do it. I told you the concept, I told you the steps. Whichever is comfortable, present it in exams. I recommend this for exam because in exam, time constraint, time management will be a crucial element. Still second part, third part of the question still is there. But anyway, first let us complete this. So write it down. Any doubt, let me know. So when should you this approach for exam? When a delta is asked. When a delta is asked. Or when they talk about hedging in options. When they talk about hedge in options. Like in this problem, no, they asked to create a portfolio hedge. So when they ask hedge in options or when they ask delta, you follow this approach. They will not tell you follow portfolio replication approach. But if they ask you delta, if they ask you perfect hedge in options, in those cases it's understood you have to follow portfolio replication approach. Okay, hope it is done. Okay, remember this first part of the question. Now, first part of the question, the same problem can be solved by risk neutrality approach. Let me solve that. risk neutrality approach. Risk neutrality approach. So here what do we do? First we find out risk neutral probability. What is that? Let me tell you. We have today market price and we have after 3 months. So today market price, what is the spot price? 600. Now it can go up to what number? It can go up to 780, or it can come down to 480. High price, low price. High price, low price. Okay. Now if I want these two numbers into one single number, I want to take an average. How do I do an average? I multiply it by probability. Let's say probability of going up is P. The probability of coming down is 1 minus P. I know they have given the probability. Don't use that. We want to find out risk neutral probability. That is a probability such a way that the portfolio is risk free. Means what? Such a way that the shares and risk free security provide same returns. Risk neutral probability. Risk neutral, risk free. You can say risk free probability. Risk free security provide same return. I'll explain the logic also, don't worry. I will, once I written it, I'll explain the logic also. Okay, so what is the expected value? Expected market price using this probability, that is 780 into probability plus expected market price 780 into probability plus 480 into 1 minus probability, remaining only two possibilities are there. So how much it becomes? Expected market price 780 P into 480 plus 480 into 1, 480 minus 480 P. If I simplify, 780 minus 480, 300 P plus 480. Okay, now this is market price. This is market price after 3 months. Now spot price 600. And how do I calculate? How should I calculate this probability? Such a way that it provides same return as risk free. So 1 plus risk free rate. 1 plus risk free rate. Right? So 600, if it was a risk-free security, how much it would have given? So spot into risk-free rate, 600 into risk-free rate, 600 into 1 plus risk-free rate, 10%, 0.10 into 3 by 12, 10% only, no? Yeah, 10% into 3 by 12, 3 months. This should be equal to this expected market price, 300p plus 480. That is 600 into 1.025 equals 300p plus 480. The 600 into 1.025, 615 minus 480 equals 300p. So 300p equals 135. So p 135 by 300, 0.45. Interpretation also will write down. First you calculate p, probability of going up is 0.45. Risk neutral probability, not the probability based on historical data. So first step in risk neutrality approach is compute probability. Okay, have you written till here? Then we'll write the interpretation of this 0.45. Okay, write down. Probability of 0.45 implies, okay, or the write down, risk neutral probability of 0.45 implies, risk neutral probability of 0.45 implies, risk neutral probability of 0.45, risk neutral probability of 0.45 implies 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 if the probability of the price, if the probability of the price going up to 780, if the probability of the price going up to 780 is 45%, if the probability of the price going up to 780 is 45%, 40 is if the probability of going up to 780 is 45%, is 45%, then then return of the security, then return of the security and the return of the risk free security, return of the security and return of risk free security, return of risk free security are same, are same, are same. Okay, full stop. Next sentence. If the probability based on the experience, if the probability based on the experience, if the probability based on the experience is more than, is more than, is more than 45%, if the probability based on experience is more than, is more than 45%, is more than 45%, is more than 45%, then security will give more return, security will give more return than risk free security, security will give more return than risk free security, than risk free security, than risk free security. than risk-free security. And vice versa. And vice versa. Did you understand this concept? 45% probability is like break-even point for me to invest in this share. If the probability of the price going up to 45%, then my risk-free security and this share both are same. If the probability of me going up is more than 45%, that means my security should give me more return. Yes, my security risky, it should give more return. But if it is probability of going up less than 45%, then my security will not justify my risk. I hope you are able to understand how do we make judgment based on the probability, not the value approach. Value more than price invest, value less than price don't invest. No, here we are telling from probability approach. If actual probability is more, it's good to invest. If actual probability is less, it is not giving better return. Don't invest. Anyway, that's the interpretation part. We don't use it much. I told you for your reference. So first step is risk neutrality approach is to compute the probability. And here also have a quick shortcut. Don't worry. In 2 steps, in 3 minutes, 4 minutes, we can solve the problem. In this approach also. But I am trying to tell you the concept in detail. Hope you're able to follow it. Okay. Then how do you calculate? Calculate the present value. Next step is value of call option. Value of call option is calculated by present value of expected intrinsic value. Expected intrinsic value means what? See, we had a spot price which is equal to 600, and after 3 months it can go up. This is today. After 3 months it can go up to market price 780, or it can come down to market price of 480. Correct? Now, in these situations, what is likely to happen to call option and probability of going up? We calculated just now risk neutral probability. This is 0.45 and coming down 1 minus, which is a 0.55. What is the value of call option? Strike price we know 480. Strike price 600. Strike price 630. Okay. Strike price 630. So what will be the value of call option? In this case, intrinsic value 780 minus 630. When market price is high, call option exercised 150. Here what is the intrinsic value? 780 minus 480 minus 630, market price minus strike price. I'll write as 0, not minus, because when the market price is less, call option will lapse. Now I need to compute the expected value. How do we calculate expected value? We multiply it by probability. So 150 into 0.45 plus 0.55 into 0. 0 value, anyway 0 you get. This is the expected intrinsic value. 150 into 0.45, that is 67.5. Plus 0. The 0 you can ignore. But this is the expected value. I need present value of it. I have to come back. So value of call is 67.5 divided by 1 plus r. Present value 1 plus r, that is 1 plus 0.10 into 3 by 12. 67.5 divided by 1.025. 65.85. And regarding if they ask you put option, what is your problem? Don't have to recalculate everything. If it is put option, what do? You can just use put call parity theorem. Anyway, first you write down till here. You got the same answer, right? 65.85. You see, we got exactly the same answer, 65.85, because both are binomial approach only. One calculated based on portfolio replication approach, other calculated based on risk neutrality approach. Approach is different, assumptions are same. Okay. Now, for exam, if you want to follow risk neutrality approach, two simple steps. One step, you calculate risk neutral probability. Formula is given by F minus L by H minus L. In fact, institute gives one more answer, R minus D by U minus D. I'll show you that as well. First, let me complete the shortcut process. Second step is present value of expected value. So value of call option is given by this. In fact, you can say C1 or something, right? This is C1. We have written this is C1 multiplied by probability, market price going up, plus C2 market price coming down. What is the value of call into 1 minus P whole divided by 1 plus R. Of course, to the power of t also, time we have to adjust. Let me calculate quickly. I'll show you how easily you can calculate. Future value, spot price 600 into 1 plus R into 1 plus 0.10 into 3 by 12 minus low price 480 divided by high price minus low price 780 minus 480. In fact, this probability value and the delta value looks very similar, right? That's why people get confused. Our delta value is high price minus strike price. Here high price minus low price. Only this number changes. Denominator is same. Their high price minus strike price. Here F minus L. Future value is lower price. Very sound similar. So people get confused, but they're not same. Approximately same. So this is 600 into 1.025 minus 480 divided by 300. Hope you get it. Same number, 0.45. Correct. Now, what is the C1? That is market price going up, or I'll calculate market price 780 minus strike price 630. Probability of going up is 0.45 plus if the market price is down, you don't exercise, option will lapse 0. This will require if you do put option into 1 minus P, 1 minus 0.45, or directly you can write 0.55 divided by 1 plus R. Directly I write or I'll write 1 plus 0.10 for 3 months, 3 by 12. Directly you can calculate. 780 minus 630 into 0.45 divided by 1.025, you get 65.85. That's all. 65.85. So two simple steps, even risk neutrality approach, you are done. So in the exam, if they just ask you binomial model or if they ask you risk neutral probability, then you should follow this approach. Compute probability first. One more formula for probability is also there. Institute use that. Let me show you that. One more probability formula, same answer you get. They will tell you R minus D by U minus D. Or they say 1 plus R and D percentage down. So in this example, what is 1 plus R? 1.025 I will write. Hope you understand 1 plus R, that is 10% for 3 months. Minus down, what is down? It can down to 480, right? So D equals 480 by 600. Means it can come down by 20%, 0.2. So 1 minus 0.2, you get 0.8. 480 by 600. 600 can become 480. So 0.8, 80% fall. Sorry, 80% remaining. By upper side, what is U equals to upper side? 780 by 600. 780 by 600, 1.3 minus 0.8. You can check out, you get the same answer. 1.025 minus 0.8 by 0.5. You get 0.45. In fact, what you are doing, everything you divide by 600. See, this is on rupee basis we calculated. This is percentage basis we calculated. This is per share basis. It's percentage basis. So ultimately, answer will remain same. Anyway, whichever is comfortable, you can follow it. Okay. Okay. Now this is value of call option. Suppose if you want to compute value of put option, of course, directly you can use put call parity theorem, or you can use this approach only. I'll do that also for you. Value of put option. Value of put option. Two-step approach. First step, probability. Second step, value of put option. Probability I need not recalculate. Already calculated, same number you get. Probability of going up 0.45. 1 minus p means 0.55. That will remain same. Value of put option, how do you calculate? Direct formula I'll do. You can do C1, C2, or you can do P1, P2. So what will I do? I'll tell like this. Strike price minus high price. You understand? Strike price minus high price. Because for put option, intrinsic value is strike price minus market price. So strike price minus high price plus into probability plus strike price minus low price into 1 minus probability divided by 1 plus R. Now, when strike price minus high price happens, basically when the market price goes up, you don't exercise. So this is 0 into 0.45. When the market price comes down to low price, put option exercised. 480. So 480, strike price is 630 minus 480 into probability 1 minus 0.45 means 0.5. Whole divided 1 plus r, 1 plus r directly 1.025. I've calculated enough number of times in this problem. So 630 minus 480 into 0.55 by 1.025, 80.487, 80.49. Okay, this is using binomial approach. This is using binomial model, risk neutrality approach. We can also solve it using put call parity theorem. Let me do that using put call parity theorem. That is value of call plus present value of strike price equals value of put plus current market price. What is value of call? We already calculated 65.85 plus present value of strike price. The strike price how much? 630. Present value divided by 1 plus R. Directly I do 1.025. Hope you get it. 10% for annum. For 3 months, 2.5%. Value of put is what I would like to calculate. Current market price, today market price 600. So what is the value of put equals 65.85 plus 630 by 1.025, 614.63. 600 comes to left side, minus 600 is value of put. So value of put equals 614.63 minus 600 plus 65.85, 80.49, 80.48, same thing. 80.48. Let's round off some more difference there. Approximately you can see, you get the same answer. using PCPT, put call parity theorem. Okay, so this is actually first part of the problem. I try to told you beyond what is asked in exam, delta calculation, value of call calculation with the logic interpretation, and binomial model using risk-free approach, risk-free probability, that interpretation, and direct step to calculate, and put option using binomial model, put option using put call parity theorem. So whatever they can ask in one problem only, we finished it. Okay, I hope you have done till here. Actually, some more part of the question was pending. Let us go back. Only first part of the question we did. Second also we did. What should be the value of option today? What is the expected rate of return on the option? So only that part, that's final part is there. I'll calculate here itself. Okay, so today what is the value of call option? Today what is the value of call option? We calculated 65.85. 65.85. And on expiry, that is after 3 months, what will happen to the value of call option? They told you market price can be equal to 780 or market price can be equal to 480. What will happen to the intrinsic value there? Intrinsic value may be equal to 780 minus 630 strike price, which is 150, and it's a 480 minus 630 that you don't exercise when market price is less. You don't exercise call option, so intrinsic value is 0. And what is that such variation? Actual variation they have given 60%, 40%. So multiplied by 60%, multiplied by 40%. So this is 90, this is 0. So if you invest 65.85 today, its value will become on expiry 90 rupees. 90 rupees. So what is the rate of return on the option? Return on investment. Return of option in percentage terms. If you in P1 minus P0, that approach 90 minus 65.85 divided by 65.85 into 100. I have some space into 100. How much percentage? 90 minus 65.85 by 65.85 into 100. 36.67%. 36.67%. Okay, this is holding period return. What is holding period return? For 3 months. That's what they asked also. But if you want to express per annum basis, just for understanding, how do you convert per annum basis? This is for 3 months. How much for 12 months? Into 12 by 3. So please tell me how much you get into 12 by 3, 36.67 into 12 by 3, 146.68% per annum. If I annualize it, not required in the problem, but I just calculate it. For one more purpose, I'll tell you. First, you write down. Today, the value of call. What could happen to the value of call on expiry? Two value of call was there. So, I multiplied by probability to get the expected value. Okay, hope it is clear. Now, why did I ask you to convert it to annual basis? There is the reason. Let me explain. You see, this probability is actual probability. What if I substitute here what I've calculated, risk neutral probability 45%, 55%? Can you please calculate for me? You got my problem? You got my question? Instead of substituting in this question the actual probability, had I substituted risk neutral probability, what would be this return? Can you recalculate? Do you understand my question? Shall I take this part out? Hope you've written it. I'll recalculate. Okay. So I hope it is done. I'll just take this part out. I just want, you don't have to write it down, just observe. If I substitute this 60%, 40%, which is the occurring based on such variation, historical experience. Instead of that, if I substitute it by risk neutral probability, what would be my answer? What is risk neutral probability? 45%, right? So into 0.45 into 0.55, what would have happened? So 150 into 0.45, I would have got 67.5. This plus 0 anyway, 67.5. So what is the return of the option will be? 67.5 minus 65.85 by 65.85 into 100. Convert it to annual basis into 12. This is for 3 months. So how much for 12 months? So 12 by 3. 67.5 minus 65.85 by 65.85 into 100 into 12 divided by 3. How much? 67.5 minus 65.85 by 65.85 into 100 into 12 divided by 3. You get 10%, I believe. Yes. And what is the 10%? The 10% is risk neutral probability. I don't know whether you're able to understand the interpretation of risk neutral probability versus actual probability. Anyway, so I just wrote for your reference, not required for exam. So even though they've asked only little things, I try to expand the whole gambit of binomial model, valuation, delta, risk neutral probability, actual probability, perfect hedging, fractional shares, everything into one problem. I hope you're able to appreciate it. So this one problem is sufficient to revise many other problems. Okay, anyway, hope it is done.